An analysis of financial market returns. Using the historical record, a statistical analysis on returns on securities traded in the financial markets demonstrates three central facts. Riskier assets have higher returns on average than safer assets. The returns of risky assets are correlated with one another, and the returns on financial market securities show no discernible pattern over time. Let's look at the historical record and the statistical measures. A portfolio is a collection of financial assets held by an investor. This graphic shows an investment of $1 made on December 31st, 1925 in each of four portfolios of securities, and the final value of those investments 83 years later in the year 2008. The four securities include U.S. Treasury bills, a portfolio of Treasury bills with 3-month maturity. Long-term government bonds, a portfolio of U.S. Treasury bonds with maturities of 20 years. Common stocks, a common stock portfolio based on the Standard & Poor's 500 index, which consists of stocks of the 500 largest corporations in the United States in terms of capitalization. Small capitalization stocks, a portfolio composed of the bottom fifth of stocks traded on the New York Stock Exchange, ranked by capitalization. Of course, when we invest, we expect a positive return on our investment, but we know that the actual realized return may be different than expected and even negative. But from the graphic, we see that historically, investment in securities had been a predominantly positive investment experience. There have been periods of negative returns, but if you held your investment over a reasonable period of time, you more likely would have earned a positive holding period return. The final values for the four portfolios range from $20.53 for T-bills to $9,548 for small cap stocks. If you invested $1 in common stocks in 1926, at the end of 2008, you would have $2,049.45. A holding period return of 2,049%. A geometric average return of 9.6%. An arithmetic average return of 11.7%. Investing in common stock over that investment period is equivalent to earning 9.6% per year. The return you would expect to earn in any given year over that 83-year period is 11.7%. We see a risk and return relationship on display. Treasury securities are practically default risk-free. Short-term Treasury bills have less interest rate risk than long-term Treasury bonds, and stocks as residual equity claims have the most risk. The Treasury securities have the lower holding period values. The equity securities have considerably higher holding period values, so investment in riskier securities resulted in higher holding period values than safer securities. Riskier equity securities seem to have more volatility in their return series. This graphic demonstrates that. The returns of common stock are in red, and they have much more volatility than the returns of long-term bonds and Treasury bills. So a risk must be related to the volatility of returns. The volatility in stock returns also has implications for statistical testing. The data for common stock returns is very noisy, and so averages taken over a short period are practically meaningless. To gain insights from historical returns, averages must be taken over a long historical period. This figure plots the histogram of the annual stock market returns over our 83-year period from 1926 to 2008. This plot is a frequency distribution of the numbers. The height of the graph gives the number of sample observations in the range on the bottom axis. This frequency distribution is our history of investing in common stock over the past 83 years. Again, we see that investing in common stock has been primarily a positive investing experience. For some perspective, over the 83 years ending in 2008, there have been only 2 years in which stocks fell between 30 and 40%, including 2008, one of the worst years for common stock over our investment record. In contrast, there have been 13 years in which stocks earned between 30 and 40%. Each portfolio of securities, indeed each individual security, has its own frequency distribution of returns. How can we describe a frequency distribution to distinguish it from all other frequency distributions? By its location and dispersion in frequency return space. For location, we want the best unbiased estimate of the return an investor could have earned in any particular year over the 1926 to 2008 period. That best estimate is the arithmetic mean return. We also want to measure risk. The dispersion of the frequency distribution measures how much a particular return can deviate from the mean return. And risk is a possibility that the realized return will be different from what was expected. Dispersion indicates risk. The greater the dispersion, the greater the possibility that what was realized will be greatly different from what was expected. Riskier securities have wider dispersions of their frequency distributions. Safer securities will have tighter distributions. The statistical measure of dispersion is variance and standard deviation. Variance is the average of the squared deviations from the mean. In each year, we subtract the mean return from the realized return in that year to get the deviation from the mean. We square the deviation from the mean. This does two things. It removes the sign of the deviation, and it gives greater weight to the bigger deviations. We do this for all years. Variance is the average of the squared deviations from the mean. So we sum the squared deviations from the mean in all time periods and divide by the number of observations minus 1 degree of freedom to get a non-biased estimate. The units of the variance is return squared. To put the dispersion measure in the same units as a mean so it can be compared against it, we calculate a standard deviation. The standard deviation is a positive square root of the variance. Let's look at an example. We have a distribution of returns over 4 years. We sum the returns and divide by 4 to get the mean return. In each year, we subtract the mean from the return in that year. So in year 1, our return is minus 6%, minus the 5.75% mean. Gives us a deviation from the mean of a negative 11.75. We square the deviation from the mean. and we do this for all time periods. The variance is the average of the squared deviations from the mean. So we sum the squared deviations from the mean and divide by 4 minus 1, the number of observations minus 1 degree of freedom. And the variance is 85.58 returns squared. To put the variance in the same units as the mean, so it can be compared against it, we calculate the standard deviation, which is the positive root of the variance. The standard deviation is 9.25%. Some statistical implications of the distribution, its mean, and its standard deviation. The arithmetic mean of the distribution of returns for the common stock portfolio is 11.7%. This is the best unbiased estimate of the return we should expect to earn in any given year in our 85-year investment period. The standard deviation for the common stock portfolio is 20.6%. 68% of the distribution's returns fall within one standard deviation on either side of the mean. 95% within two standard deviations. 99% within three standard deviations. So over the investment period, 68% of the returns fell between negative 8.9% and 32.3%. So if you invested in stocks, there's a 68% probability that your return for the year will fall between negative 8.9% and 32.3%. The risk and return relationship. Given our frequency distributions for the various securities, the arithmetic mean return and standard deviations are calculated. Given standard deviation as a measure of risk, we see a risk and return relationship in that securities with larger standard deviations have larger arithmetic mean returns. And so the first central fact about the nature of returns in the financial markets is obtained. Riskier assets have higher returns on average than safer assets. Some key numbers that you might like to remember. The return on common stock has averaged 11.7%. The return on U.S. Treasury bills averaged 3.8%. And inflation has averaged 3.1% over the 83-year investment period. Relationship between returns. Covariance and correlation measure how the returns on two securities are related. Covariance measures how the returns of two securities covary about their respective means. Do they move in unison about their means, and how perfectly or imperfectly? Or do they move in opposition about their means, and how perfectly or imperfectly? Given two securities, X and Y, we calculate the deviation of X's return from its mean and the contemporaneous deviation of Y's return from its mean. We multiply the two paired deviations from the mean and do this for every year. The covariance is the average of the products of the paired deviations from the mean. So we sum the products of the paired deviations and divide by the number of observations minus 1 degree of freedom to get a non-biased estimate. If the two returns are positively related, they will have a positive covariance. If negatively related, a negative covariance. If unrelated, a covariance of 0. However, the size of the number is difficult to interpret, and like variance, covariance is in squared unit deviations. Correlation standardizes covariance by dividing it by the standard deviations of the two securities. It allows us to better measure the degree to which two returns move together or in opposition. The correlation coefficient will vary between +1 and -1. If the returns of two securities are moving exactly alike over time, the two securities have perfect positive correlation, and the correlation coefficient is 1. If the two returns are moving exactly oppositely over time, they are perfectly negatively correlated, and their correlation coefficient is -1. If there's no relationship between the two returns over time, they have zero correlation, and their correlation coefficient is 0. Let's look at an example. We have the returns of two securities, A and B. We calculate their average mean return and their standard deviation. In year 1, we calculate the deviation from the mean for both securities. For security A, its deviation from the mean is its -6% return in year 1 minus a 5.75% mean return. Its deviation from the mean minus 11.75%. For security B, its deviation from the mean is its -8% year 1 return minus the 7% mean return. Its deviation from the mean is -15%. We multiply together the paired deviations from the mean and get 175.25% squared. We do this for all years. The covariance is the average of the product of the paired deviations from the mean. So we sum the products of the paired deviations from the mean and divide by 4 minus 1, the number of observations minus 1 degree of freedom. And the covariance between A and B is 93.67. To calculate the correlation coefficient, we divide the covariance by the standard deviation of A and the standard deviation of B. And we get a correlation between A and B of 0.81, positively correlated and highly correlated. The returns on risky assets are correlated to each other, and in general, risky assets are positively correlated with one another. The average correlation between stocks traded on the New York Stock Exchange is roughly 0.5 to 0.6. And so we have our second central fact. The returns on risky assets are correlated with one another. Let's note this for future reference. The covariance of x with itself is the variance of x. So let's put that in our memory, and we'll bring it back in a later lecture. Serial correlation measures how the returns of a single security are related over time. We ask, is today's stock return related to past stock returns? For example, if yesterday the stock had a positive return for the trading day, is it more likely that the stock will have a positive return today? Or is it more likely that the stock will have a negative return? Is there a pattern? To look at these relationships, we compute the covariance between adjacent returns in time for a time series of returns. Historically, the serial covariance of stocks traded on the New York Stock Exchange is almost zero. In fact, the serial covariance is not statistically different from zero. And we have our third central fact. The returns of financial market securities show no discernible pattern over time. The three central facts and their implications. Riskier assets have higher returns on average than safer assets. The market prices risk, and the market establishes a risk premium over the return on the risk-free asset. The returns of risky assets are correlated with one another, and it's predominantly positive correlation. That positive correlation results from economy-wide influences that affect all securities in the same manner to a greater or lesser extent. These are economic factors with a wide impact on the economy, such as recessions, expansions, inflations, instability in interest rates, changes in monetary policy, significant political events. Moreover, if individual securities are correlated, individual securities are also correlated with a market index of risky assets. Returns of financial market securities have negligible serial correlation, and the implication is that price changes are random and unpredictable.